Hello, 5i research community. My name's Chris White. I'm the head of research at 5i. Today is Friday, March 14th, and this is the TSX Weekly Wrap. This has been another tough week for the markets, although we had some positive news on the economic data front with cooler than expected US CPI and PPI numbers. The S&P 500 is down about 2.6% on the week as of recording, although it reached as low as 4.5% down on the week. And it's down about 6% year to date and officially marked a 10% decline from its highs. The TSX is about flat on the week as of recording, although it was as low as down 1.8% on the week and down about 1% year to date. So in this weekly video, I wanted to touch on some of the things that I talked about last week with the VIX curve. And I also wanted to talk about the market structure right now, since I think that's really important in this current environment. So first, we're just going to be looking at some Canadian stocks that are hitting new highs this week. So first, we have Pan American Silver, Triple Flag Precious Metals, Extendicare, and Hydro One. So it's kind of a good mix of sectors here, but we are seeing a common theme and underlying trend of precious metals being one of the leading industries so far this year. And then Hydro One hitting new highs makes a lot of sense as utilities are traditionally a defensive sector. Extendicare is an interesting one. It's actually in the healthcare sector. So that makes sense from a standpoint of that's also a defensive sector. But this is a name that is interesting in the Canadian space because there's not many healthcare names outside of the cannabis kind of industry for healthcare. And so it essentially offers long-term care services. So kind of an interesting name there and an interesting mix of names. And this is their returns year to date. So quite good, especially relative to the broader markets. Okay, so onto the VIX curve. So last week I highlighted that, the spot VIX, the current VIX was higher than the forward 3-month VIX, which historically signals positive forward near-term returns. I also noted that it's lasted for 5 consecutive days, which was about the average length that this indicator stays positive for. So last week I mentioned that I thought it could uninvert this week. And as of today, it does look like it could close below zero, so uninverting officially, which I think is a positive signal for the markets, at least in the near term. We are seeing a good bounce in the markets today, and the VIX is falling. The curve is uninverted so far. We'll see if it closes like that. And then barring any headline risks over the weekend, I think this would be a positive signal for the markets in the coming weeks. If that does close like it is so far today. And so we can see this is data as of yesterday, but we can see that kind of reversal in the spread there. So looking at past instances where the curve has been inverted for longer than 10 days, I did mention that the average length is about 5 days consecutively that the curve stays inverted, but we're running on about 9 or so. I looked at instances where it lasted longer than 9 days, and we see about, 10 instances since 2005. And really, outside of the 2007 and 2008 instances, all other times were very close to the market bottom at that time. So, investors can kind of fact check these dates and look for themselves too. I've laid them all out there. But I think that, unless investors are expecting a 2008 style scenario here, I think this is could be quite positive signal for the markets here. Okay, so next I wanted to highlight market structure and some potential paths for the S&P 500. So being down 10% from its highs is actually a really important and critical level for the markets. And while this chart may look chaotic, it's called a spaghetti chart. What we're looking at is really the S&P 500's recent drawdown from its all-time high. That's the red line. And then all other instances where we saw at least a 9% correction is in gray lines. And these are all, it's important that these are all, bull market corrections of 9% or more, essentially 10%. And we can see that in most cases, it bottoms right around 10%. And in a few instances reach as much as 15%. Mostly it's in between 10 and 15%. And, we can see the recovery time to all-time highs ranges from about 30 to 350 days. But we can see most of those recoveries are clustered around 30 to 150 days, which in market trading days works out to about 2 to 7 months. So that seems to make a lot of sense to me, and it's really fascinating to note that these are all instances of essentially 10% corrections since 1950. We can see about 20 instances. While it may look chaotic at a glance, looking at them individually, there's a lot of commonalities among them. Next, we're looking at the S&P 500's past declines of 9% or more, but these are in bear markets. So we see about 15 instances since 1950. The drawdowns can be quite severe. Most of them lasted at least a year or more till recovery, although there were a few other instances that were a lot quicker. But by highlighting these two very different scenarios with the bull market recoveries and the bear market instances, I really wanted to highlight, whether an investor believes, we're in a 2000, 2008, 2020 flash crash or 2022 bear market sort of scenario, or whether this is simply just a 10% correction within a bull market, like what we saw in the previous slide. So I think it's really encouraging that historically there's more frequency that we hit a 10% correction and then resume higher, rather than some sort of ominous recessionary bear market. So I laid out these scenarios just to show that a 10% correction could eventually turn into something worse, but there are fewer instances here. Not all of them are that bad. 2018, some of those 2020s were only 15 to 20%, whereas the 2008, 2000s, those are much larger. But I think a lot depends on what an investor thinks is going to happen going forward, and whether or not we're actually going to get into some sort of recession or not. So just outlining a few individual scenarios of what could happen based on historical price kind of market structure historically. So the first is the most recent 10% correction in the markets was August 2024. We had the yen carry trade unwind. So we saw the market quickly move into a 8-ish% drop. It bottomed and then it just kind of grinded higher and dropped again a little bit 35 days in, and then resumed to new all-time highs. The next scenario is September 2020. We were climbing a wall of worry. So we were coming out of that March 2020 flash crash. The markets got really volatile later in the year. We saw the markets draw down about 10%. So we bottomed, we went up, almost back up to the highs. Then we revisited the lows, and then we went higher again and went to new all-time highs. January 2018, so early 2018, we started to see some tariff kind of headlines and some rising interest rates. The markets went down 10%, subsequently went up, double bottomed back down to 10% again, and then just kind of grinded higher up to new highs. Now onto the bear market scenarios. So the first is the 2022 bear market. So we saw a very similar decline to 10%, a bounce of 5 to 6%, and then another leg lower, and then so on and so forth until we kind of found a bottom around 25% down. The next one is late 2018. This was a bit of a flash crash kind of. We saw the market correct 10%, chop around a bit for a couple months or more. And then we had one quick flush lower. It was like a waterfall type decline. The market drew down about 20% total. And then we had a V reversal where the market, kind of recovered quickly. So those are all the sort of scenarios that I've laid out that, just kind of show the different ways that the market can move. But essentially, a lot of what we're seeing is, the markets hit a 10% correction. We bounce, and then a lot is determined from there, whether we, go back up to new all-time highs, or if we see another leg lower. A lot will really depend on the path of, the Federal Reserve, the White House, interest rates, corporate earnings, all that sort of stuff. So we really need to see, what's going to happen going forward. But 10% corrections don't always lead to some sort of extended bear market. So I think that's really important to highlight. Okay, lastly, economic data for next week. We have US retail sales on Monday, the Canadian inflation print on Tuesday, and then Canadian retail sales on Friday. That's all that I have. Thanks and have a great weekend.